Good evening to all, and welcome to our new EBI event, an academic event which is co-organized with several institutions which, as a matter of fact, have taken the lead for this. The one is the University of Turin, and in particular Federico Riganti, who is the heart behind this event and has very carefully structured the program in 4 sessions, the first of which is today. And then a second co-organizer is the US Phil, a center in Italy, run by our dear friend and colleague at the EBI, Michele Siri. And the third one is the ADE, which is an institute for the research of law and economics, mainly in banking and finance, in which the president is another dear colleague of ours, who is not present today, but still very active in our activities in the EBI, Antonella Schiarone. The EBI is hosting with great pleasure this event and is contributing in the sense that members of the academic board will be chairing and moderating some brilliant young researchers, some of which are affiliated to the EBI and others not, I would add, yet. So we very much hope that some of them will find it appealing to apply to become members of the Advanced Researchers Group, if they are not already so, which, by the way, is run, among others, by one of our colleagues, the former president, my predecessor as president of the EBI, to whom I will in 1 or 2 minutes give the floor, Professor Bart Joosen, my dear friend Bart. So as a matter of fact, this is a joint product of work which was initiated by Federico Riganti, by Filippo Annunziata, by Concetta Brescia Morra, who is also now with us and will be cooperating with Bart and monitoring this first event, and the other institutions, as well as the EBI. As you know from the program, we will have 4 sessions, 2 in April and, if I'm not wrong, 2 in May, and this will allow us to go into more detail on a variety of subjects which are of interest to the academic world and, of course, to the EBI being a hub of universities dealing with financial regulation, lato sensu, including all the aspects which are included in the agenda. As I told my other colleagues before we started the session, it is impossible for me to speak 15 minutes to introduce a topic, so I will stop it here. I very much hope that we will enjoy some, I assume, excellent presentations. I will be with you also to attend, and also an excellent moderation. And I very much hope that this will prompt questions to which answers could very hopefully be provided. And I very much encourage you to stay with us in these spring events, spring talks, for their entirety. So to find the time to come in the second and the other events and spread the news if you are satisfied with the events to your colleagues and friends. Without further taking more of your precious time, because we have some very interesting presentations to be made, I give the floor to my dear friend Bart. Bart, you take it over from me now.
Thank you very much, Christos, and welcome everybody to this very first session of the spring talks. Indeed, if you look at, let's say, the organization of the further sessions, they are very much exciting from let's say, the perspective of the very different topics that will be organized. And so I would like to start to congratulate the organizers with setting this up, and particularly Federico, who has been quite active in thinking, structuring, designing basically this very interesting concept, and also the taking the effort basically to organize this. I also welcome a number of indeed had the members of the Associate Research Group. Indeed, Christos, some of them, some of the speakers of today, basically already active members of that group, and so it's good to see also them back again. Although online, we are able basically to meet from all different places, and that's I think also the benefit of this format and this formula basically of the organizations. As you already alluded to, we have four very interesting papers that will be presented by the researchers. I would not refer to them as junior researchers, because there is already from my first review of the documentation and the abstracts basically being put on the table by the four participants to today's basically session. A great deal of maturity in the thinking, and a great deal of experienced researching visible from that, and so I quite look forward to the further discussions of this afternoon. I agreed with Concetta this in preparing this particular session, that I would take 5 more minutes of your precious time basically to have a bit of an introduction of the various topics that we will be discussing at, and Concetta will then basically particularly moderating the 4 sessions. We agreed with all the panelists of today and of the session of today that we will have 4 individual presentations, and after each individual presentation we will have some 10 minutes discussion with the presenter of the paper, and then we will proceed with the next paper. So what we will start with is Ugo Malvagna, and then Edoardo Martino will present Eugenia Macchiavello, and Anna Weber will basically close the session with the presentation of her paper. Reading from the abstracts or the full papers basically that we have received from the participants, I noticed that one of the common denominators that you could observe basically from this particular the 4 topics that will be presented common denominator is for me also a bit the lessons learned from the COVID crisis. In essence, COVID crisis, basically, we are grateful that we are nearing the end. It's not over yet, but we do see a lot of more relaxation, basically, in let's say the restrictions that we all had to live with. Unfortunately, whilst we are basically getting rid a little bit of the COVID crisis, we have this horrible, as if I may say so, horrible development in the Ukraine. My thoughts are each day with the people of the Ukraine, and I think I'm sure that that is also the case for everybody participating in today's event. But from the perspective of the presentation of the topics that we will be listening to today, this seems to be one of the common denominators of the papers, that at least the COVID crisis either resulted into some lessons learned from the way basically our societies needed to operate in view of the restrictions. Particularly Anne Weber's paper is also looking at the viewpoint of what you hear back a lot is that we are all seem to be very much pleased about the technology taking over from let's say the traditional branch banking and what have you, basically, so that technology enabled society to continue making payments and doing banking business and so forth and so forth. And Anne Weber basically in her paper points out, okay, we are seen, or it seems that we are at risk, basically forgetting a very important group of society, and that is the elderly people, because had the assumption that everybody can work well with let's say the innovative products or payment products or banking products is of course a sort of assumption that ignores potentially indeed this very important point. And I'm looking forward to the further reasoning and the further suggestions that Anne Weber will be making in that particular point, because personally I felt when reading her viewpoints basically that this is a very important point to be discussed. Two papers of today will also be discussing basically new technology from the perspective of both sides of the financial markets, if you like. New technology, and particularly distributed ledger technology, decentralized publication, the new technology basically being brought to the table for both, if you like, money creation in the form of stable coins on the one hand, and very importantly also, which I found back in the analysis of Edoardo Martino, which will be presenting, is the current state of play, if you like, with the introduction of the MiCA regulation and the constraints that Edoardo is basically observing in and the flaws that could be observed with respect to MiCA in the context of particularly the topic of financial stability. Very important point. Maybe in the moderation and in the discussion with Edoardo, we could also look perhaps a little bit at the viewpoints expressed by Markus Brunnemeyer in his paper for European Parliament, where he also looked at the subject matter of financial stability, certainly, but also from the perspective of monetary stability, from the perspective of currency exchange issues that might arise. So perhaps that could be a topic that might be also tabled today or perhaps later on, but certainly one of a very interesting perspective. The other paper that discusses and debates basically distributed ledger technology and the new techniques basically with respect to and innovative techniques basically is particularly looking at the securities markets. A paper of Ugo Malvagna, who is looking at the opportunities that new technologies may bring, basically of more efficient clearing and settlement processes within the securities markets, and particularly also looking at the potential need to critically monitor and critically evaluate, if you like, the existing regulatory framework with respect to the suitability to accommodate the arrival of the new technologies, basically, in that respect, but then with the perspective not from a payment product, but more from the perspective of security settlements systems in that respect. Intriguing points that have been laid out, and we will be listening to that particular paper presentation later on. And last but not least, frankly, is the paper of Eugenia Macchiavello, in which she, again, inspired also from some lessons learned in from the COVID crisis, is also looking at the particular potential that fintech may bring in order to unlock, if you like, sustainable finance with in markets basically where the current framework for the raising of sustainable finance, at least her analysis seems to suggest that the current regulatory framework is particularly doable, if you like, for the larger companies, for the larger institutions, for those parts of the economy that are able basically to meet all the very stringent compliance requirements stemming from the new frameworks that have been adopted recently in Europe, but that particular framework might not be necessarily suitable for other parts of the economy, and particularly small, medium-sized enterprises. So where Eugenia basically will be talking about is whether or not fintech will be able to assist in unlocking that sustainable finance market, also for businesses that might not necessarily be able to cope with quite stringent compliance requirements. At least that is one of the points that Eugenia will be presenting later on. Very intriguing hypothesis, I must say, but it's more than a hypothesis because Eugenia is basically quite far in the production of the paper, and it is now soon to be published, as far as I understand, in a reputable journal, probably later this year. And then basically we'll all be able to read the very challenging, I must say, very interesting analysis that Eugenia has been making. So 4 topics, must say, quite all of them looking at regulation, but from different perspectives. Anna Weber perhaps more from a policy viewpoint and looking more at a higher level. Other papers really deep dive into current pending legislative proposals that are on the table and analyze basically those from the perspective of whether or not they are fit for purpose in view of the various challenges. And other papers also look more at policy objectives, after having noted that perhaps regulation might not necessarily be fit for purpose for the arrival of new technologies. So without further ado, but this was our idea of to put some teasers on the table for the audience and to present to you a little bit the richness of what we will be listening to this later this afternoon, and to make sure that everybody has a bit of an understanding about the following presentations, and have sufficient appetite to start listening to each of the various presentations. And having closed this brief introduction, I would like now to proceed and to invite Ugo Malvagna basically for his first presentation. He will be talking about the DLTs and market infrastructures and technology, neutrality and decentralized finance. So without further ado, Ugo, basically it's your turn to take over and to go on the stage.
Thank you. Thank you, Professor Joosen. Yeah, as it was already said, my intervention is about how DLTs, so the technologies that leverage on the use of decentralized ledgers, can be implemented in the securities market infrastructures, meaning both the clearing and trading aspect of secondary markets and the central the functional central depositories, meaning the ones that perform the settlement function. I will also consider in this analysis how the DLT pilot regime would address these issues. So my presentation basically is set up of 4 parts. In the first one, I will try to briefly, in a non-technical way, of course, based on the fact that I'm not an informatic, try to point out what are the point of interest for securities market of this kind of technology. So why this technology can be useful in the evolution of these infrastructures. Secondly, I will try to point out the fact that given the nature of these infrastructures and their dimension and their interconnectedness, at least at the European level, this area is not fit for a regulatory approach based on the logics of wait and see, meaning let's wait for the market to develop and then we will try to regulate it, because this innovation is arguably regulatory driven, in the sense that only as far as regulators and legislators would create legal certainty in terms of which business models and which technologies within the broad notion of DLT would be fit for being implemented in market infrastructure, then only under this condition then the needed investment will come. After that, I will try to, and consequently, I will try to address the issue of whether security settlement systems are regulated in a technology neutral way, meaning that if they are fit to embrace this kind of evolution at this in their current state. And I will also have some insights on the DLT pilot regime that, as you probably know, is in the making. It is expected to come into force next year, but this is a temporary framework. Basically, it is a huge European level sandbox, so it's not it's not a framework that is going to take over and substitute the current CSDR and its implementing acts. And finally, I will try to draw some conclusions in terms of this kind of regulation being fit for the purpose, and trying to set out some ideas about how it should evolve and what are the high-level political choices that the European Union will have to address in order to drive the market towards the expected evolution. So I will start by saying that even if DLT is as a technology is commonly known, especially with reference to digital cash, so stable coins, cryptocurrencies, and payments area in general, there is room for interest of this kind towards this kind of technology, also in the field of securities, because of more than one reasons. First of all, the very nature of these ledgers being decentralized or distributed, so architecturally not concentrated in one subject, is itself a reason for transparency. So it would help all processes where transparency is sought. Secondly, one core issue is the flexibility and scalability of tokens as the output of DLTs, meaning that this technology enables let's say the enriching and the enlargement of investable assets, both in terms of new asset classes and in terms of fractionalization of existing securities, meaning thresholds for an investment to be at the individual level to be carried out. So instead of having thresholds of, I don't know, 500,000 for a private equity deal or a club deal, through tokens, this threshold could be lowered. Then we have the issue of automatization, meaning that tokens are basically smart contracts that would function on a blockchain. So this comes with the possibility of making some processes fully automatized, meaning that no physical or personal intervention is needed for a process to be carried out, including corporate actions, meaning calculation of payments to be paid, of dividends to be paid, other events happening in the life of a listed corporations, including eventually voting. So this is interesting in the perspective of reducing operational risk and streamlining processes. But the actual benefits in terms of cost reduction and then streamlining of processes is connected to how DLTs could ameliorate and scale up the quality of and the efficiency of transfer in the secondary markets. This is basically due to the possibility that is inherent the technology to have so-called on-chain settlement, meaning that instead of having at least 3 different moments through which a transaction on the secondary market happened, meaning the actual trade, the clearing of the transaction through the central counterparty, and the settlement. DLTs enable these 3 moments to happen simultaneously, and this happens basically through the possibility to have transactions registered in real time in this distributed ledger, meaning that there are no consequential activities to be done by different agents, and this is made even more, let's say, efficient and secure whenever in the chain there is a native currency or payment token, meaning that the DLTs, the chain, at the same time can register the transfer of the security, so crediting the purchaser of the security of that token, at the same time using a payment token to discharge the price obligation. So having just in one moment what happened currently in several phases that required basically at least 2 days to be carried out. So this would also come with a significant mitigation of settlement risk and counterparty risk, meaning that the risk of transactions that appear to have happened, but at the end of the day are not, because the seller didn't have enough security to sell. This kind of risk shouldn't be there if we have a simultaneous on-chain settlement. And on the other side, counterparty risk should be solved in the sense that the simultaneousness of the transfer of the payment token would avoid this kind of risk, could avoid this kind of risk. So this is broad high-level description of the level of streamlining that we would have in terms of phases to be carried out and the number of agents involved in this activity. So instead of having basically one agent for each phase, we would only have the DLT platform that enables the transaction to happen, and at the level of the smart contracts, the chain would register the transfer of the token and the transfer of money, whatever it means. Another perspective to look at it is describing processes, and so making clear that the current process is based on sequential number of events, meaning that the exchange trading venue would have to match orders and then communicate these events to the central counterparty. The central counterparty would have to do the clearing. Then we would have to move to the CSD, and alongside that, the payment system would be involved in order to transfer money as the consideration for the purchase of the security. So instead of having this sequential logic, we would have a concurrent logic, meaning that all involved actors would be able to access simultaneously the ledger, so that this process, the very idea of how these processes are structured would change and be carried out at lower cost and in lower times. Of course, given the nature of these infrastructures, it is clear that for this kind of change, meaning actually implementing these technologies in a securities market, quite a lot of investments will be needed. So without a clear legal framework in terms of what it is possible to do through DLTs in this market and what are the business models that are viable from a legal standpoint, the level of innovation would be, let's say, suboptimal at the very least. Alongside that, we also have to consider that the law could help to mitigate some problems that would inherently come with this kind of evolution. I just listed two of those. The first one is a problem of closed loops, meaning that let's assume that we have multiple platforms where securities are traded. Then we have the problem of interoperability, meaning that we want to have a system where the fact that these securities are traded in private environment, so-called decentralized applications, does not hamper the liquidity of the market. So this is one problem that we would have to face. The other one is that as far as regulation remains as it is, a lot of activities that ledgers, decentralized ledger would be able to carry out autonomously would have to be repeated at the central level, meaning the central ledger that is kept by the central security depositor. So this problem can be seen at the level of notarization, meaning when securities are issued and created, maintenance, meaning how top-tier securities accounts are kept in functioning, and actual settlement, meaning the transfer and the register of the transfer in the chain. So there are a lot of issues that could be addressed in this analysis. I just want to outline three of them and address the first one, that is the one relating to the materialization. So the core issue that I have so far identified are the problem of dematerialized form that is required by the CSDR, the regulation on central security depositories, that requires the form of book entry as the form that is necessary for a security to be registered in a CSD and then to be actually traded on a trading venue. Then we have the problems relating to finality. So the actual finality of the settlement. So the fact that the transaction cannot be reversed. And this is a problem that was addressed by quite an interesting paper by Hossein Nabilou with reference to proof of work blockchains. Basically, here the problem is that based on the nature of the technology, it is not always possible to come to the conclusion that from a legal perspective, this transaction is already performed. And then we have the third problem that is relates to outsourcing of functions that is quite central in this analysis, because the level of the extent to which an activity can be outsourced basically shapes the real structure of the market. So the problem with DLT is that the role of gatekeepers or depositories can be somehow emptied from the inside, and it could end just in an oversight function of some activity that is performed by other subjects or that is totally automized. So as I said, I just want to address the first issue, meaning book entry form. The book entry form as the notion of dematerialization under the CSDR. The problem here is that the law requires the book entry form as the form that all securities that are going to be traded in secondary markets must have. The law makes clear that there is no one only method for a book entry to be physically structured. The problem with that is that some DLTs, they do not work based on a book entry, so they do not have actual accounts. So this is the case of the most famous blockchain protocol, that is Bitcoin, that is based not on an account model, meaning that you have account for each participant having a balance, and when a transfer occurs, the account of the seller is debited and the account of the purchaser is credited. But you have a process, a model that is based on the so-called unspent transaction output, meaning that you just want to follow and to trace how Bitcoins, tokens more in general, and fraction of Bitcoins would move from one party to another. So it's not subject-based, but it is object-based. The problem here is if this is consistent with the requirement of the book entry form. Probably it is not, and this is why in the DLT pilot regime, an exemption can be granted based on this discretion of the authority with reference to this form. So we will see, and significant insights will be coming from what will happen under the DLT pilot regime if we can abandon or we can enlarge this notion in terms of how securities transfer can be recorded. At the same time, we also have the problem of delivery versus payment, meaning that generally the DVP, so the transfer from one party to another of a security, is based on the payments in central bank money or in commercial bank money of the consideration of the purchase. In DLT platforms, this could theoretically happen, but the real streamlining would come from, as is already said, having a payment token. So this is another point that we would be experimenting under the DLT pilot regime. So having a payment token, an e-money token, as the consideration for the purchase of security. So the other problem is that one other problem is that in some cases, by somehow stretching the rules, we may arrive to the point of making the current legislation consistent with new technologies. The problems arise when we have the use of the blockchain in order to basically change from scratch the market structure. So we could have, I would say, 3 levels of decentralization. So we could have the first level, that is merely a streamlining activity of what already happens in legacy processes, so to have less cost, but the same actors in the environment, the same typologies of intermediaries carrying out their functions. So the problem here is that through outsourcing, we could arrive to a situation where these intermediaries, they would do anything but supervising or having an oversight on what other subjects would do. Then we would have, and this is a problem in itself in terms of regulation, then we would have a higher level of decentralization, basically avoiding all activities that are different from the notarization function, so the issuance of security by a CSD. And of course, in this environment, a lot of functions and subjects carrying out existing functions and processes would be made redundant. So this is a problem for regulation that assumes that these intermediaries have something to do in the process. And then we would have an extreme hypothesis scenario where everything is made redundant, everyone is made redundant out of the actual platform working as a trading venue, based on the fact that the DLT would enable all transaction from the beginning to the end to be carried out on-chain. So the problem here is that when we have this kind of change, meaning a change that involves the very structure of the market, meaning the business model that different actors of the ecosystem work on, then by definition, regulation thought in my point is that we will have to see what happens during the experimentations carried out under the DLT pilot regime, but probably we will go towards a modular framework, meaning that different sets of rules in terms of licensing requirements and roles and responsibilities within the ecosystem would be differentiated based on the market model, let's say. So based on one of the three alternatives that I set out there, or more than those three alternatives. And finally, I just want to signal that it's not sure that all these three models are desirable from a social perspective. That is the one that, of course, the regulators would endorse. So it appears to me, also considering that alongside this potential evolution through DLTs, the European Central Bank has launched a project of consolidating payments settlement mechanism and security settlement mechanism, also making the hypothesis that DVP could occur in that context through central bank digital currency, that there is some kind of competition between an idea of market infrastructure that is based on private infrastructures working on DLTs, where the role of the regulator and public entities is just an oversight role, and an opposing model that is a public model, meaning that this kind of function would be undertaken from a substantial point of view by the ECB and used to create a more streamlined process, but that is fully under control of the ECB. So I think that I should stop here. I'm sorry if I talk more than I was allowed. Thank you.
So then I would like just to say a few words to all the participants to this webinar. I think that is a very interesting occasion for young scholars and for people not so young as I am to enter into debate of a topic that as the paper from Anna-Marie Weber illustrate clearly, it's quite difficult for people, for elder people like me. But in any case, we should mix up the very interesting reflections that young scholars have made, and in order to put together a point of view that is from a person like me that has a long experience in the regulatory field with your energy. And I thank you very much, Ugo, from your very interesting presentation. I guess I would like to raise first some questions, very broad questions that listening at your presentation were insisting in my mind. What you are thinking, you are debating about the role of regulation in this field, no? I think the main topic is the role of regulation. You are asking, for example, if you started saying that regulation is essential to give legal certainty to the transactions in this mechanism of DLT and the market infrastructures. But then I understood from your presentation that what you want is mainly to delete, to overcome some legal barriers. So the kind of intervention of the regulation could be to delete some legal barriers in order to not obstacles operators to freely put in place transactions. And then again, one of the legal barriers is the one regarding the accounting model, that impede to the most well-known cryptocurrency, Bitcoin, to can access this kind of market infrastructures. Then you say, yes, but when we are speaking about regulation, you say, I mean exactly rules that allow private infrastructure to work, not the intervention fought by the ECB regarding the central bank digital currency, imposing a public model of DLT. The role of rules. I would like to ask you one point. Do you think that there are any differences on which type of regulation we need, considering the different interests at stake? Because you have put together transaction on securities, you are speaking about market infrastructure mainly, but when we speak about cryptocurrencies, I agree with you that cryptocurrency like Bitcoin is to some extent a security. We can qualify more a security because it's not stable. It's as a currency, could not be considered having the main characteristic of any currency, so it's not stable. But thinking about the choice of ECB, the choice ECB is clearly determined to driven by the idea to offer another kind of money. So what do you think? Yes, I understand your point of view. We need rules, but we really do not need the rules. We do not need the rules different for different types of products in order thinking about which are the interests we would like to protect. In the case of currencies, I know very well that probably there will be the second presentation from Edoardo Martino, regulating stablecoins, that will raise some points. And now I would like to see, this is my first question, very long, but probably easy for you to answer. Sorry for this. I would like to see if there are questions from the audience. I do not see if there are in the chat. Please, I see that there are almost 60 people connected. Please, probably Ugo may answer my question first, too long. Next time I will shorten, be confident of this, but I don't see any other question from the audience, but I invite the audience to do so if they like using the chat, or I don't know if they can raise the hands. I'm afraid they not.
Okay, maybe please. I can say a few words on your question. Well, my point is that the idea of regulation being technology neutral means that you need to have a framework that, regardless of the technical means, would be able to protect with at a sufficient level all involved interest. And this is something that we can achieve when we have when we are relying on existing market structures and existing business models. So when the CSDR regulates the value chain of secondary markets, moves from the assumption that we have a central depository, we have settlement agents, we have trading venues, we have intermediaries at the single client level. The problem here is that this technology is so different that it would enable a different structure of the market, more than one further structure of the market. So it is by definition impossible in this context to have technology neutral regulation. So either you would maintain this framework, but this would basically mean that you are granting a position rent to the existing actors, because they basically would end in doing nothing but oversighting a completely automated process. So they would evolve in being supervisor, but I mean, we have the supervisor. They do not have to act as the agent of the supervisor. So in this context, probably the most neutral solution is to have more than one framework based, regulatory frameworks, based on the actual model that one market is adopting. So you will have a fully decentralized market structure, then this kind of set of rules applies. You have an intermediate, a mid level of decentralization, then you need to have different actors, because in the other scenario, probably, I don't know, settlement banks would not be existing. In this scenario, you would need to have different actors and regulate those different actors, and so on. Or you want to maintain legacy systems, but just having them updated through a new technology, and then you can maintain the existing regulation. But at the core of that decision, I think that we need, I mean, as a European, let's say, citizen, we need to make a decision based on the following aspect. Do we want a public infrastructure? That is what we have been going towards in the last 20 years, meaning Target 2 securities working together with Target 2, meaning that we would have a DVP public infrastructure? Or do we want to enable private to create their own infrastructures? Because if we tell that we are okay with that, but we do not adopt legislation, this will never happen. So we have to clearly decide that. This is my point in few words.
Thank you. Yes, I agree to some extent, but I don't believe in technological neutrality like you. Absolutely not. Yes, I don't believe that. And also, I strongly believe that it depends on the technology has imposed a characteristic very important, that is a common characteristic for any product, that is decentralization. This is the core point of our discussion, decentralization. Now, but I guess that in any case, in a decentralized system, we can have also different types of rules for different products. And this is my point, because money, currencies are different from securities, and they involve different problems that should be regulated differently. But I understand your point, and we should analyze better which are the consequences of the decentralized finance and what we want. Probably if there are no other questions,
Concetta,
Bart, I see you have a question.
Yeah, I had one question, if I may, if we still have the time, but just very quickly. As you know, at this particular stage is a lot of debate about high frequency traders, right? And this is the race to speed. So in the sense that high frequency traders basically by investing in, if you like, infrastructure and in technology, try to speed up basically their potential to participate in the securities markets. And there's a lot of concern about the potential market abuse effects of this particular point. So in a sense, if I understand your analysis correctly, you are basically saying, okay, we would all benefit from speed, because at the end of the day, it's you do a trade and it is settled immediately. Whereas the trend, as far as you can observe basically at this present state, is that regulators tend to think that it would be more useful in order to have the true ability to monitor what's happening in the markets, to delay and to build in, let's say, certain pauses to say, well, we don't want basically certain securities trades to take place within the millisecond. We want to push basically the button and say, we want to delay the high speed and the high frequency trading at this particular point in time. What would be your analysis to this particular point of market abuse concerns that are expressed and are visible, and where everybody is fed up basically in the role of high frequency traders in the securities markets, not giving sufficient time to everybody basically to respond, to reflect on the price discovery, and the point that regulators are really truly considering that we would benefit from less speed in that respect. So that would be my question to you.
Thank you. Well, this is a super interesting point. I mean, high frequency trading is basically a massive amount of orders being placed, and so that it is up to the CCP or the trading venue to try to match those orders with opposing and opposing orders. I mean, sell order versus purchase orders. I think that this depends on the fact that we do not have instantaneous DVP. If we would have instantaneous settlement, this wouldn't be possible. So I think that DLT in this perspective could also help to mitigate those problems, because smart contracts enable the regulator and the trading venue to a higher level of control and ex ante on how parties can behave on the market. So high frequency trading is something that we have to deal with, because currently we do not have the technical means to block at the moment of the placement of the order this massive amount of orders. We have ex post rules that are market abuse rules, but we do not have an ex ante means of enforcement. Through smart contracts, this is something that we theoretically could achieve. The other thing that is relevant in this perspective is that it is up to who is programming the smart contract having immediate or deferred settlement. So what we are sure of is that we wouldn't have any more, or we would have strongly mitigated counterparty risk and risk of settlement. But in order to manage liquidity issues or liquidity constraints, it could also be possible to program tokens and smart contracts so that DVP would be deferred, I don't know, to the end of the market day. So the central idea is that this technology enables a much higher level of control ex ante on how parties would behave, and alongside that, it is able to reduce typical risks that we face in secondary markets, meaning settlement failures and counterparty risk.
So you're more or less suggesting basically it will stop basically the fake trades, which because that's typical for a typical constraint that is seen at the high frequency traders basically put 1 million bits on the market and then not properly execute them. So basically you would say it would ex ante basically prohibit or prevent these fake trades basically being put in the market. That's basically what you're saying.
Yeah, this is something that, as I understand, is technically feasible only in smart contracts, not in current infrastructures.
Thanks. Very interesting.
Thank you, Ugo. Thank you again. Yes, also on this point of the possibility of ex-ante supervision, to what extent it works. Of course, you said, I agree with you, it's technological feasible, this ex-ante control, especially in case of smart contracts. So the regulator, the supervisor can assess the characteristic of the smart contracts ex-ante, so to know how will behave the firm. But I'm as an old former regulator, I'm a little bit skeptical about to rely a lot to an ex-ante, conceiving ex-ante all hypotheses could happen in a contract because contracts are incomplete. But we have a lot of debate on this point. Thank you very much for this presentation. And if there are no other questions from the audience, I guess that I should give the floor to Edoardo Martino. Is the second in the pipeline? Yeah. Edoardo, please.
Can you see my slides?
Yes, we can see your slides. You have a
Great.
paper, as Bart presented, on regulating stable coins, private money and liquidity risk. Please, the floor is yours.
Thank you very much, and thanks especially to Federico for organizing this and inviting me. What I will be doing in the next 15 to 18 minutes is to bring you through the framework of a working paper of mine. So I will introduce a bit the topic. I will try to set an analytical framework to understand how we should regulate stable coins, looking at financial fragility, some lessons from the past, and try to understand and decompose competing regulatory goals. And then only at the end, I will go through stable coins and the European approach to regulating stable coins. So the idea is that the MiCA regulation is public domain. I think what my paper and this project add is a framework to analyze that regulation. So I would focus on that, and then we can go to the legislative part in the Q&A if you're interested. So my big issue is that I'm not a huge believer of the most evangelic approach to financial technology, and especially to the blockchain. As I was listening to Ugo and the discussion, there were a lot of words that are against the basic promises of blockchain. So control, remedies, governance, and control a lot, which is supposed not to be the case, right? If you truly believe in the basic promises of the blockchain. And so what I'm wondering is what is old and what is new in what you can do in the blockchain, and this is an application of this very broad question to stablecoin. So what I will be arguing is that stablecoins are, in the end, nothing new. Stablecoins are a form of private money. We have been dealing with private money since forever, and we have been learning a lot over the centuries. I can say we have been learning a lot in the global financial crisis, but we have been learning a lot also from experiences that come from very different point in time, and I will try to give a couple of examples. Then I will criticize the EU regulation, not because I take special pleasure on criticizing EU law, but simply because EU law is a front runner in the matter. So the first point of my framework is to focus on liquidity. And focus on the inherent instability of the financial system. So this comes from Minsky instability hypothesis and especially endogenous instability. So financial instability is generated endogenously by the system, and nobody believed that. And then the 2008 global financial crisis arrived, and now we started to believe in Minsky. And crucially, in Minsky, one thing that is sometimes underestimated is that the quality of legal rules and the design of institution of the institutional framework matters. And I applied this to the very specific point of liquidity because it's crucial for financial system in general, but more specifically for private money and stablecoin. Liquidity is all in all very difficult to define. Is a catch-up concept. You can apply it to different aspects of financial transactions. What we have learned in the last 20 years is that liquidity is not a free good. So most of the time, economists and also lawyers, when discussing prudential policies or investor protection policies, always assume liquidity as a free good. So if the price for a security is the correct one, if the market can price a security, there will be a buyer. We discovered that that is not the case. And that is not the case, especially for institutions that transform liquidity. So take on short-term, make short-term promises to creditors and extend long-term and risky creditors. So when liquidity dries up in the market, the illiquidity of the market, so of the illiquid asset, foster the illiquidity of the funding. So it's more and more difficult to attract short-term funding, which in turn can lead to fire sale of assets that are illiquid. So you take a loss on that, which in turn again incentivize short-term creditors to run. This self-reinforcing loop in liquidity has been studied mainly by a paper by Bruno and Meyer in 2009. You may be familiar on that, and shows how liquidity spirals triggers run. In the regulated sector, so it's a standard rationale for regulating banks the way they are regulated nowadays, but especially, and it's more and more problematic in the regulated sector, and we're going to see a couple of examples of that. The next step that I'm considering is that financial systems are legally construed. Here I resort to the work of Caterina Pistor on the legal theory of finance. So this way to allocate entitlements and to exchange and to make short-term liquid promises is a function of the law and the quality of the law. And more specifically, to be able to offer liquidity, the law must allow to grant strong legal entitlement to investors. Only with strong legal entitlements, investors can feel safe and accept a short-term promise from a bank, for instance, is the easiest way to conceptualize it, but also from a money market fund or from other financial institutions that make more sophisticated promise. But the idea is always the same. To make the promise credible, you must promise liquidity, so the possibility to withdraw or redeem at any time, and you must offer security, so the possibility to guarantee that this withdrawal or redemption is at par. Those are the key features of private money, and those are also key features for stablecoin. What is key, and again is a function of the law, is that so long as the issuer of money have no fiscal capacity to back this issuance, and this is the case of sovereign state, a backstop provision seems to be necessary, whether it is a de jure backstop provision, for instance, for insured deposit, or it is a de facto backstop provisions. For instance, the bailout expectations for banks, but also the bailout that happens for non-banks that were, in a sense, illegal. They were made legal to prevent the system to implode. Crucially, strong legal entitlements are procyclical. And this goes against the very foundational literature in law and finance. So we started in the late 90s with the idea that strong legal entitlements, strong legal protection of investors foster financial development. That literature has all sorts of problems I'm not going to discuss now. But one key flaw of that literature is that if you take into account finance, strong legal entitlements and strong investor protection as a procyclical component. So it fosters development probably over the social optimum in good time, but then it's very difficult to adjust in bad times. And so in bad times, when liquidity dries up and systemic externalities materialize, those strong legal entitlements are still there, and investors can exercise them, of course, and impose externalities on society. So this again builds on Katarina Pisto's work and Gary Gorton partly. What is key to note here is that strong and rigid legal entitlement generate safety, generate the perception of safety in investors. You wouldn't buy a share of a money market fund if you would not perceive it to be safe. And you perceive it because you have a legal entitlement to redeem at any time at constant net asset value, or at least that was the case before the global financial crisis. We're going to talk about what happened after. A couple of historical examples that in the paper I develop it more, but I think it's interesting just to mention them to show that this is really a long-lasting story, and we know a lot about that. We may forget lessons that are taught in history, but we know a lot. So the first I analyze is the Bank of Amsterdam. That is considered a proto-central bank. The first central bank never became a real central bank because all the receipt and coins that the Bank of Amsterdam issued were always redeemable through direct redemption or through a receipt system. And after a couple of centuries of going pretty well and kind of financing the Dutch golden era, the Bank of Amsterdam imploded exactly because liquidity dried up and there was a run on the Bank of Amsterdam. The Bank of Amsterdam had no fiscal backstop, and this run could not be sustained exactly because of liquidity transformation between short-term liquid liabilities and illiquid assets, since the bank started to invest in more and more illiquid assets, and this is also key. So the transformation between the liquid liability and illiquid and risky asset. The second example I consider is the US free banking era. So there's a lot of research on that. Again, Gary Gorton leads the way. So before 1863, there was this many US states had this free banking system where every bank could issue a banknote so long as they deposited treasuries of the state. These banknotes could circulate. They were discounted according to geography and riskiness of the state. But again, relying on the collateral was not enough, because you under-issue these banknotes and you risk to increase too much liquidity transformation. So many of these free banks, and especially through the banknote channel, fail very quickly. And after 1863, that is a key year for the National Banking Act that was mainly due to finance the Civil War, but then had a huge impact on the development of the US banking system. The new type of banknote was uninsured deposit. So we were living in a situation where common deposits were de facto shadow banks. So there was no deposit insurance, and according to the Banking Act of 1863, national banks could issue deposits so long as they were licensed nationally. And again, these, since they were uninsured, especially during the Great Depression, this created a great deal of bank run. And the end of the story is deposit insurance. So after some years, they learned from the lesson of the Bank of Amsterdam, and deposit insurance and fiscal backstop was introduced to prevent run. The third element is the structural, I would say, shortage of safe assets. So safe assets is something that is key to the financial system. Investors want safety. Safety is important to post as collateral in any financial transaction, and this safety yield a convenience premium. It has been proven empirically. What is crucial is that finding assets that are safe and that are not publicly issued, meaning treasuries, is more and more difficult. It's very complex to find a store of value that is also liquid. And it has been proven that when the state does not provide enough safe asset in the form of private debt or public debt, the private sector tries to offer close substitutes. How do you offer close substitute? Through legal entitlement, granting strong legal entitlements on short or long-term debt that is often backed by other debt, as in the case of AAA mortgage-backed securities. You can create assets that are very similar to private money and that are usually accepted as safe and liquid asset in collateralized transactions, for instance. So knowing on hindsight, living after 2008, we know that that is not a good idea, or at least it's not a good idea if not all the preventive regulation that is needed is in place. Because that, yes, granting strong legal entitlement on all these sophisticated financial transaction allows to create safe assets that boost financial booms. But when liquidity dries up and when systemic risk materializes, investors that are entitled with these strong rights can run. And the whole point of having strong rights is the possibility to run if needed. And the last example is, of course, money market funds. I will discuss it in one slide because the main point of the paper is very close functional similarities between money market fund shares and stablecoin, and this has regulatory consequences. Before going to money market fund, I hope I persuaded you that creation of private money is by large a function of the law, and by far is a function, this possibility is a function of the regulatory goal the regulator has in mind. What's the problem? There's a trade-off. I don't call it trilemma because it's a little bit abused as a word, but there is a trade-off between three key regulatory goals. The first is preserving financial stability. The second is preserving or fostering investor protection and market integrity, and here granting strong legal rights to investors is, of course, central. And the third, that here is number one, is to foster financial innovation, which is another way to say regulatory competition, right? So to make your jurisdiction palatable for innovation. It is difficult, if not impossible, to achieve all three because they entail different tools. So one can try to put together financial innovation and stability, or financial innovation and investor protection, or investor protection and innovation, but it's very difficult to achieve them all. So we need to take decisions. And spoiler, the decision that MiCA takes on stablecoin is to be very, very cautious on investor protection and make an environment that makes crypto asset market palatable in Europe. I'm very skeptical about the financial stability part, and I'm going to detail a bit my claim. To do so, let me introduce briefly the business model of money market funds, because it's very similar, as I said, to stable coins. Money market funds before the global financial crisis were common investment funds, and in Europe they were incorporated as UCITS or alternative investment funds, depending on the nature. And crucially, these type of regulations, rightly so, look at investor protection. What was not in the picture is that money market funds make short-term liquid promises, the promise to redeem share, that is functionally the same of a bank deposit, without being limited by banking regulation. And that's the whole point of how money market fund, the money market fund industry started in the US. So they promise liquidity and security on demand, through share redeemability at constant net asset value, so long as the fund does not break the buck. And again, all of this is possible because of contract and property rules and regulatory arbitrage. They were often backed by sponsoring banks. That is, again, a contract between the sponsoring bank and the fund, which has consequences for society because it can spread losses. And this money market fund started to invest in more and more illiquid assets. So they were not narrow banks anymore, but they became quite mismatched in terms of liquidity, because of course illiquid assets yield more than treasuries, for instance, that are very liquid. After there was a huge run, I'm not telling you news about this, there was a huge run on money market fund in the global financial crisis that boosted the global financial crisis. So we came up with new regulation that, at least the European one, I think is one of the best example of post-crisis regulation in terms of safeguarding financial stability. And this new regulation limited the possibility of offering securities and liquidity on demand, established different ways of calculating net asset value per share. So you can guarantee constant net asset value only if you are really a narrow bank now. Backstop provisions are prohibited. So backstop provisions from private entities such as sponsoring banks are now prohibited. And there are early crisis management tools in place, like liquidity fees or redemption gates that, if liquidity dries up, prevent a run. So we moved from, and that was a political decision implemented with legal tools, we moved from a system where innovation and investor protection was the focus to a system where financial stability is the focus. And here I come to stable coins. I say that stable coins are similar to money market funds because, again, they are crypto assets that purpose to maintain a stable value relative to specific assets or a pool of assets, and they do so the asset link that are now the more developed ones via reference to physical reserves, such as US dollars or other liquid reserves, liquid or less liquid. Algorithmic-based stable coins are less developed, but probably more risky and with more possibility to scaling up, perhaps. And they rely on over-collateralization. And again, the historical examples are useful because, of course, they are backed by cryptos. Cryptos are volatile, and so you rely on over-collateralization. But that can also create, and probably, especially that, create liquidity problems. So what are the traditional critique and point of discussion on stablecoin? Is the relationship within the relation with monetary policy and monetary sovereignty. So the CDBC discussion is related to this, which is something I don't touch, and is the point of investor protection and market integrity that are traditional capital market law goals and that are pretty much in line with what MiCA does, because MiCA by far and large is the, allow me to be unspecific, is the blockchain version of MiFID by far and large for the way it is formulated. My additional layer, I think by now is pretty clear, is looking carefully at financial stability, especially through the channel of liquidity risk. That is the most difficult to handle. And the key elements for having liquidity risk and risk of run on stable coins are all there. So you promise liquidity and safety on demand. This promise is backed by reserves. So the quality of these reserves and what you do with these reserves, or what you can do, what you are allowed to do with these reserves is crucial. And you promise redeemability at par. And that's why stable coins are so important for the crypto economy, because they are not supposed to be volatile. And the point is, as with all financial transactions, is how credible is this promise? And the credibility of this promise depends indeed on the quality of the reserves and on the type of liquidity shock. And I would add on the quality of the law that aims to minimize liquidity shocks and to guarantee high quality reserves. The additional element is that my understanding is that the idea that stablecoin should be a means of payment is getting more and more out of fashion already. Facebook withdrew the Libra and then Diem project, and my understanding is that stable coins are becoming more and more a medium of exchange in the crypto economy. So they allow the decentralized finance application to run on the crypto economy without always converting into fiat. So they're basically grease between the wheels of the crypto economy, and they can act as a bridge between the crypto economy and the traditional financial system. What is the problem with this is that if this is the case, stable coins arrangement will face huge stress in times of high volatility of the crypto economy, because it may become, and there's some evidence that already is becoming, a flight to asset in times of crypto volatility. Which would stress from a liquidity perspective the resilience of this stablecoin. A paradigmatic example is Tether. Tether is, let me put this bluntly, laughable in terms of the reliability of the promise. It has been proven, and there are even judicial evidence that Tether are not 100% backed. So if there is if liquidity dries up and if there is a run, there's not enough reserves to cover Tether. What is important for Tether stability is a redemption fee. So only institutional investor can redeem, and a big fee is applied. 0.1% for redeeming Tether is a high fee, and the first mover advantage of Tether. So the utility that every user gets from using Tether does not really depend on the quality of itself of Tether, but depends on other user using it. So there is a network externalities. And so long as the system goes, everybody is happy. When the music stops running, somebody will be without his or her chair, according to a very famous say on the matter. Having the theoretical framework in mind and stablecoin in mind.
Sorry, Edoardo, the time is running. We should leave. Please, may you go to the conclusion, because
I am getting to the conclusion indeed.
Yeah, thank you.
The European approach on stablecoin is twofold. There are asset reference tokens and e-money tokens. E-money tokens are really tightly regulated, relatively tightly regulated. You can do much more with asset reference token. I may have some doubts on who wants to use e-money token. And the main idea is that according to marketing crypto asset regulation, especially on asset reference token, you can do a lot, quite a lot, of liquidity transformation, still offering redeemability on demand. So you can entitle investors with strong legal entitlement and at the same time perform a lot of liquidity transformation, exposing yourself to liquidity risk. So the trilemma or the trade-off is settled very much in favor of investor protection and follows pretty closely what was done before the global financial crisis with money market fund, and the interests of financial stability are pretty much on second priority, so to say. It's a bit different with e-money tokens, but again, I think the main challenge is on asset reference token, especially looking at what is applicable to what type of stablecoin arrangement. So those are my conclusions, and the only point I want to highlight in the conclusion is that regulating convertibility, and in this case redemption, is a key and very understudied element in regulating crypto assets in general, and in this case specifically. Stablecoin, it can be a very powerful point of entry for regulators to preserve financial stability and to have a say in the crypto economy. Yeah, and sorry if I went long. Yes, 25 is a bit long. Sorry for that. And yes, look forward to your question.
Thank you, Edoardo. I should have stopped you because we have two other presenters ready too, and at 5 we should stop, and so we should leave them time to enough time for them to present their papers. If there are no questions on the chat, I would like only, I have a comment. I was surprised, may I say, listening to your presentation. You speak about redeemability. So you are thinking not to a currency, an instrument to pay, but as something similar to a deposit, a bank deposit. So you are comparing the cryptocurrencies, for example. If we speak about Bitcoin, of course, is similar to fiat money. The money you are speaking about are similar to bank deposit money. So you are thinking about redeemability because clearly e-money is not also, as the definition of the directives are not deposits, no? It's clear that when you give money to obtain, to use this money as e-money, you are not speaking about a bank deposit. So redeemability is something that is behind a bank deposit, and the problem normally arises because banks use this money to grant grant loans to people. So really, I understand your point about the problem of financial stability, but for example, I don't see the problem if we are speaking about cryptocurrencies or other, and also to stable coins to some extent, to some extent, but we can discuss.
If I may add one more question, and then Edoardo can pack them together. And then I was just wondering, Edoardo, whether you have been able to see also the Brunnermeijer report to the European Parliament of January. And there basically also, apart from, let's say, the points that you are suggesting and discussing and debating, basically is also concerned about what he calls, I think, if you like, currency circuits. So in the sense that introduction of new stable coins, cryptocurrency or whatever, basically also has a bit of the risk of suppressing monetary stability. And whether you would be able to discuss that also a little bit.
Yeah, thank you very much. I will take first Bart question, whose answer is probably unsatisfying but pretty straightforward. I have scanned the Brunnermeijer report, and I think we are doing complementary things. So there's clearly a monetary stability issue. But the answer to that can be by far and large to offer central bank digital currency, which by all means would be technologically and financially superior to stable coins and to more general cryptocurrency arrangements. So you squeeze out this problem by kind of catching up with technology, which is to an extent also the point Brunnermeijer is making. My point is complementary to that. You may be able to do that from a monetary policy perspective, but in the crypto economy, you need a safe asset or an asset that is considered safe. And that can only be privately created, which are stable coins. If that is the case, then you have the problem of financial stability, not through the monetary channel, but through the liquidity risk channel. So I think what we're doing is complementary. I'm not sure this is satisfying, but I can't talk much about that because I'm not an expert on the monetary aspects of cryptocurrencies, of stablecoin specifically. On the point that Concetta was making, it's a function of the law. It's a function of the law and what the law allows it to do. It's not a problem for Bitcoin or for other cryptocurrencies because you cannot guarantee, you cannot promise.
You do not promise anything. This is the point. A lot of this, they do not promise redeemability.
No, of course,
you are buying
yeah, but the difference with stablecoin is that you do, and you can legally with MiCA.
Yes, but in any case, it's not a deposit. You should
not even money market fund shares were a deposit, and still they were run upon. And that's my point. It's functionally similar to a deposit. It's not a bank deposit, of course. I wish it was a bank deposit.
No.
So you are kind of linked to deposit insurance, backstop, and you pay the price of regulation. But since it is not, and the law allows you to entitle with strong legal rights that are prone to be procyclical and allows run, that's exactly my problem. They are functionally similar to a deposit, but they're not a deposit. So there is a financial stability risk. So in a sense, it's exactly my problem. And I don't know, probably if you see it from a different perspective is the whole point of my paper.
Yes, but people, yeah, but we have no time to discuss. But when you give money to an intermediary that offers you money, you simply want to use a different form of electronic, a different means of payment. And different is when you are investing investing in a financial product. These stable coins are not a way to invest in financial products. Money market funds are a way to invest in a very liquid, and you say, you are right, it was not as liquid as they promised, but money market funds are an investment in securities. Stable coins offer you a means of payment, and I guess are different and should be treated differently from the regulation. A means of payment transforming fiat money to electronic money.
Well, if it is like this, I agree, but
investment are made only to avoid the problem of instability of the value, as is the case of cryptocurrencies. It's not a way to ensure the redeemability. But
if it is like this, I agree, but it doesn't seem to be like this in practice, nor in the upcoming regulation. That's my problem.
The regulation.
Yeah, we can discuss it.
They are converting. Yes, I know. But if you see Metaverso or the money produced by Facebook was a completely different idea. But now in Europe we have created an infrastructure on this. But this is what happens. I have the same impression you have that Europe regulation tend to over-regulate things, having afraid that something similar to deposits can arise somewhere. Bank deposits, sorry. But sorry, I should cut the discussion because otherwise we have not enough time for our kind colleagues. They are two ladies and I'm very happy to introduce them. Eugenia Macchiavello, Green Fintech, and Green Fintech, how to mix those problems. We will have a more relevant problem, so it's a way to solve the problem of green sustainability. Fintech, it's a way to support the probably this is the purpose of your paper. You should stick please in 20 minutes. In this way we have a 10 minutes delay, but not more than then. Thank you. Eugenia, please, the floor is yours.
Thank you very much. I cut short the thanking, but I want to thank you all for the opportunity. So what is my paper about? It has been already perfectly synthesized, but the first question is, what is green fintech? I mean, we have been talking about a lot, and now you can find a growing literature on this topic. When I started my interest in it, it was 2017. There's not much about, but then it has been grown. And there's no an official definition, of course, so I will try to give you an idea, but basically it's the application of technology to financial services, and in particular to sustainable finance. And the idea is trying to find the solutions to the problems that we can realize and we can spot in sustainable finance. The two universes have been separated for a long time, but we have we have had in the last couple of years a lot of interest also by the European Union into this particular topic. So the convergence between sustainable finance, sustainability in general, and fintech. So the idea of the paper is try to understand whether there is synergies between these two, and in particular whether green fintech can provide answers to problems in the area of sustainable finance. In fact, it's a very interesting and growing sector, sustainable finance. So the way to channel money from to sustainable companies, but to do that we need a lot of infrastructure to allow transparency and communication of data. And it's not always easy, this process. In particular, the problems that I'll try to highlight very quickly for the sake of time is that, first of all, it's a very expensive process. So as Bart was pointing out at the beginning of this session, small and medium enterprises are generally cut off. We'll see that in the Sustainable Finance Action Plan, the idea is actually to cover also small and medium enterprises. So more than ever, we need measures to reduce the cost of going through ESG evaluations. So technology can be an answer also in this sense. We have also problem in having reliable data for ESG rating, for investment decisions, and we'll see that there are technologies that might help with that. And the same for comparability. So companies use different formats and provide different information. And so the problem is that then the investors and the rating agency, when they need to assess and decide their investment, they cannot compare data from different companies, sector, etc. And the same rating agency, they have been shown different methodologies, criteria, scoring. So there's also a consultation going on right now by the European Union on how to correct ESG rating market. So the idea is to verify whether we can find solutions in fintech. And of course, these at the same time when the European Union is trying to also adopt a lot of legislations in the area, but we have verified that in some cases they can go hand by hand. So what are these technology that can be useful? We have mapped in the sector, let's say, in three main areas. The first one that I will go through very quickly, again, for the sake of time, and I'll focus only on the second group, is the capital raising market. So we have already mentioned, for example, tokens, but there is also, for example, crowdfunding. I will just mention, since MiCA and DLT pilot has been already mentioned, that in many of these solutions, we see that there are, for example, energy grids where green energy, of course, is produced, and the production of this green energy is rewarded through tokens that can be used to buy other energy, or sometimes even to buy other services at partners' company. So this is, I think, very interesting because it can have different functions also from a regulatory point of view, and as I discussed in the paper, not always it's clear how and whether it would be covered by the two legislation that I've mentioned and have been discussed also just before me. But the idea here is that this kind of fintech can help small and medium companies to reduce the cost for capital raising, of course, and for ESG analysis. But let's focus on the second group, that is the use of DLT and artificial intelligence in the infrastructure for sustainable finance. In particular, there are already experimentations to use this technology to expedite the process of issuance, for example, of green bonds, but also to provide more transparency, again, through DLT, and also in terms, for example, of reporting of the impact in terms, of course, of ESG or environmental impact, and so to provide investors with an immediate reporting about the true environmental impact of their investments, instead of waiting for the annual reporting, for example, in any way from self-reporting and not data coming directly from, for example, satellite or other measures. In fact, also through the comparison with data from satellites, newsfeed, and NG reports, etc., we can also try to validate the data provided by companies. That, as I said, it was one of the problems in sustainable finance. How can we rely on data that are self-reported and without verification? So this apparently should give a better access to data, and also to improve from the quality point of view of data, and at the same time also comparability. In fact, we can use the artificial intelligence to extract data from the reporting from companies, and use the same, for example, to the assessment by ESG agency, rating agency, or investors, and so use also unstructured data or different reporting format. That was another problems that I've mentioned before. And this goes hand in hand with other, some sustainable finance action plan measures that I mentioned. The one also about high value data sets, so the sharing of data that has a public interest, but at the same time also the recent corporate sustainability reporting directive that will review the non-financial reporting directive. And the idea here is to introduce technology also in reporting through tags or other artificial intelligence readable documents, and create a database, the European Single Access Point, in order to collect non-financial information of European companies. And this, of course, in theory, could be a great advantage for small and medium enterprises because of the reduction in costs that I've mentioned. The third group is about compliance, especially from financial intermediary point of view. I'm not going through this, it would take too much time, but just to mention, sustainable finance legislation have created a big regulatory burden on investment firms, in particular managers of investment funds, advisors, etc. Also in terms of disclosures. So here technology could help again save and make more efficient this compliance. But what are the risks? These were just the upside, but what about problems? There's obvious difficulties in seeing DLT as a solution from an environmental point of view, since there's a lot of discussion, especially in case DLT uses proof of work technology because of the high energy consumption, but also the material used, data center, etc. It's difficult then to from the waste point of view, so to dispose of all these equipment. So there's basic technical problems here. But there is also a social problem. In certain cases, there's problems in terms of job losses or exclusion of the elderly, as will be discussed just in a few minutes. But let's now focus more on the regulatory issue more than other types of issue. Here, I would need, of course, more time to distinguish between the three groups and the regulatory issue involving these three. So I need to apologize for, let's say, talking about all together instead of distinguishing. But as you might have noticed, the paper is more than 50 pages, I think. So in 20 minutes, it's not easy to cover everything. But we can again distinguish problems from prudential point of view and from an investor or consumer point of view. From a prudential point of view, we need to be sure when we want to implement these kind of solutions in sustainable finance fintech area, that we are not introducing actually systemic risk by using throughout the system the same technology in order, of course, to facilitate interoperability and therefore having more standardization. Second, when we use DLT, and for example, it has been proposed also in case of the European single access point for non-financial data to use DLT, there are some governance issues. Some have been already mentioned before, but what is more I think here interesting is that generally DLT is considered secure because it's decentralized, but of course the DLT the models that would be introduced in this area would be more centralized for obvious reason, to control, to have more control over, to find solutions in case of discontinuities. So we will lose the advantage in this case of DLT. I will skip the investor protection issue in the specific context of crowdfunding ICOs, since I've already mentioned a little bit the classification of the tokens, and investor issue, of course, are related to that. But I want to focus on the second group, as I said, and so on the issues related to the use of DLT, artificial intelligence, and also of these technologies in the European single access point. So first of all, in order to say that we have found a solution to all problems in this area, we need to ensure that the data that are inserted in the DLT and then shared with everybody and used as a basis for the ESG assessment and the ESG investments are of high quality. We can use, for example, oracles to do that, but there's no much discussion on how to be sure that, for example, the NG reports used or the data from the satellite are really correct and reliable. I've been talking with a researcher that is involved in the area of aid to third countries, that sometimes it was possible to trick the satellite, posing some green papers on the ground, of course, very big, in order to provide the idea to the satellite that the trees were planted, but it was not such. So if we can so easily trick a satellite, we need to be sure that then when we use this data for our investments analysis, they are reliable. Related to DLT, again, we have the problem of decentralization and who is responsible for what. So there is a discussion, the consultation, for example, about the ISAP again on the role of ESMA or European authorities, the role of national authorities, but again, it's not clear who will take care of problems that happen on the DLT, for example, or on the systems, and in particular, even what is the role of nodes, of developers, etc., in all this. Second, it's true that now the use of algorithm and artificial intelligence to assess companies, people, etc., is widely used. But if we want to make it by law something that it's possible, that we want to incentivize, we need to be sure that there's a way to contest, to dispute the results of the algorithm, because there might be some problems. Right now, there are a lot of, for example, ESG ratings agency that use algorithm and data from satellite, from online, etc., to evaluate firms. But the problem is that we don't know which is the algorithm used, what are really the criteria used, and so we cannot rely completely on the results. In addition, small and medium enterprises might be at disadvantage in all this because they don't have really IT skills compared to big firms. The other problem is that putting more data available, of course, for the public interest is good. For the rating agency, it could be good, but could also be a competitive disadvantage, because at that point, their methodologies will make the difference. And so they will not be available for disclosing the methodology, since the data are already public, while up to now rating agencies were used also because they had access to data, while investors had not. So to conclude, I believe that this green fintech or sustainable digital finance area is very interesting, and that this is a paper that we just wanted to start a discussion on this, but in the next year I will focus on different aspects that I've just mentioned in the paper and go further. So I think it's a good area, but there are challenges, and we cannot go further in this area if we do not solve some problems. And again, I think that common aspects from the legal point of view has been, especially from the crowdfunding and ICO area, that we need to harmonize many aspects in terms of what is a financial instrument, investment services, but also how tokens or other financial instruments can be transferred. And this relates also to what Ugo was discussing. On the other point of view, also, we need to find cross-sectoral solutions to the treatment of DLT, artificial intelligence, in terms, for example, of liability, who controls what, transparency and monitoring of algorithm, etc. And this is compared to what is being discussed also at European level about robots and artificial intelligence. Is not very clear if it works also in the financial sector industry. So I'll stop here and thank you very much for everything. Here just the paper that I've been presenting, and this EBI working paper of 2020, but it will be published soon in the European Company Financial Review in a different updated version. Thank you again.
Thank you, Eugenia. A very promising topic, but a lot of things to discuss yet. As you said, the main issue, I think, on the green finance, green sustainability in general is the reliability of data. And we should think a lot. Probably, as you told during the presentation, technology could be of help to solve this problem, but we need still to study the topic. And I stop here because we are late, and I don't want to give to Anne-Marie Weber enough time for her. I'm sorry for the audience. We have a little bit too long. We have been a little bit too long, but the papers were so interesting, also the discussion. And so I'm sorry, but we should ask, we hope the audience will be so patient to expand the time to attend this conference. Please, if Bart has no comment, I can give the floor to Anne-Marie Weber with a problem of combating exclusion of elderly people. I am afraid that as a boomer, not even baby, a boomer, I'm one of the person Anne-Marie will speak about with technology, but we will see. Thank you. The floor is yours, Anne-Marie.
So yeah, good afternoon, everyone. Thanks very much to the organizers for letting me present my research during this panel. I am actually very glad that I am the last one to go in this session, as the previous presentations actually serve as a very good point in case for the problem that I'm going to present today. So the growing powerful nexus between technology and financial markets we have been talking about today is without any doubt a huge challenge for both lawmakers and regulatory supervisors. The core observation that led me to take up this topic I'm discussing today was that current research on the digitization of financial markets, I mean, of course, quite understandably, but very clearly focuses on the legal challenges that arise for the active participants in that process. So both on the financial institution side, as well as on the side of the, let's say, digitized customers. What I aim to do with this project is to shed some light on those groups of customers who are very much affected by the digital revolution, but yet they fail to become its active, or better to say, voluntary participants. So two caveats up front. First, what I'm going to present today is, a research project in its nascent stage, and not a fully developed paper or argument as you have seen during the presentations before. So yeah, forgive me if I am unable at this stage to provide any definite conclusions or legal solutions, because at this point I'm more at the stage of finding the right questions to ask within this project. But as I'm seeing this project definitely as a trans-border European challenge, I thought this event might be a good occasion to open a wider discussion about this specific problem, and also maybe initiate some cooperation on that if someone's, of course, interested. Second caveat, I am not alone in this project, and I feel not only obliged but also very happy to mention the two doctoral candidates that are also mentioned on the slide here, who are my co-investigators. So just to start off with some general remarks on the basic aim of this project. So there are two, let's say, fundamental goals which I try to pursue. First, what I call the digital exclusion of the elderly from financial services must be well understood. So aim number one of the project would be to examine the challenges which the rapidly progressing digitization of financial services raises for older people. Aim number two would be to design the appropriate legal response to this diagnosed problem. And I do purposely call this a legal roadmap, as I do hypothesize that actually a set of legal measures will probably be needed instead of just one singular instrument to address this whole problem. But I will talk about the transfer of the basic aims into a concrete research plan a little later. So moving on to the underlying observations that led me to investigate this topic. I would say there are basically three of such observations that drew my attention to this project, and also, in my opinion, justify the significance of this research. So first of all, the already mentioned growing powerful nexus between technology and financial markets. I probably do not need to elaborate on this point on this forum, as it was already the theme of our discussion today. So just to sum this up, despite maybe differentiated dynamics across member states, which I think is true, and maybe also across different sectors of financial services, we can probably all agree that financial markets are going through that rapidly advancing digital revolution. So what might be important to note at this point is that we should generally understand this digital revolution as profit-driven, right, by the financial institutions. As a rule, and not going into the details of time horizons, digitization in general reduces operational costs. The second observation, which I found to be crucial for the research significance of this project, is the societal fact of aging, and also termed as aging societies. So global societies, and in particular European societies, are aging at an unprecedented stage. So in recent decades, the demographic structures of European societies have experienced significant transformations, and they are expressed in an increase of the portion of older people in society in comparison to younger people. Direct causes are multiple, but of course the higher life expectancy and lower birth rates are the prime reasons here. The figure that you see on the slide now displays the percentage of distribution of global population by age group during the last decades, and also a projection in the future. This is a snapshot of the global picture, but in the European context, the phenomenon of an aging society is even more visible. So already now in the European Union, around 22% of our population is 65 years or older. And in the year of 2100, this percentage is expected to increase to about 33%, or 1/3 of our whole population. So, of course, this phenomenon in itself gives rise to a number of, social, economic, political, and also cultural consequences. For this research project, the realization of this proportion is probably crucial for recognizing the relevance of the population group we are talking about. So, as I said, it's 1/3 of our population. So, beyond any doubt, the problem of digital exclusion of the elderly is not some kind of marginal or neglectable societal issue. The third part of my underlying observations kind of links the fact of the rapidly aging populations with the fact of the rapidly progressing digital revolution. So this third observation relates to initial empirical evidence on the exclusion of the elderly from digital financial services. And when I use the term evidence here, I actually do so in a broader meaning. So that it includes both the theoretical literature, let's say, derived indicators that digital exclusion, might be a thing, as well as the scattered empirical evidence that is already out there. So first of all, a strong case can be made to identify the elderly as a distinct group of consumers on financial markets. This group of consumers is characterized by lower financial literacy than young people. This, on the one hand, may result from reduced cognitive abilities of the elderly. And research shows that this cognitive decline has certain implications to the so-called financial literacy index, especially in people over 60 years of age. On the other hand, older people also lack experience in using new financial instruments or technologies that were just unavailable at the time when they were in their, let's say, most important moments of learning in their lives. The EU's flagship document titled New Consumer Agenda Strengthening Consumer Resilience for Sustainable Recovery, published in 2020, does mention older people as a distinguished or distinct consumer category, but actually no specific policy implications have emerged from this general mention so far. I also want to emphasize that while the effects of digitization marginalize the elderly in multiple ways, the basis for assuming the relevance of this project is that financial services are just of peculiar significance. Financial inclusion, that is in particular the capacity to execute payments for goods and services, is instrumental to any other activity of the elderly, which is aimed at satisfying their normal daily needs. Another very important barrier limiting the digital development of the elderly as active participants of the financial market is also the low level of income, which mainly consists of pensions and also high expenses for health. This might in particularly be true for Central and Eastern European countries, where this for sure is a huge issue in the whole problem of digital exclusion. And also, whereas the progressing digitization in the distribution of goods and services and rendering non-financial services still did not extinguish like the viable, let's say, traditional alternatives. So you don't have to shop online. You can still quite easily find a store to do your daily shopping in the traditional way. The digitization of financial services is very special because it often discards the traditional alternative path in a permanent and abrupt way. So the elderly clearly prefer face-to-face contact when it comes to finances. Of course, the majority of the evidence in that claim comes from the commercial banking sector. So as a consequence, older people are among the least likely to use online banking. And as you maybe have noticed, a trend of disappearing bank branches could be witnessed within the EU, for several years or maybe already a decade. But certainly it seems that the COVID pandemic has expedited this process very much, as financial institutions were also attempting to or trying to limit in-person contact. So I don't know about your personal experiences in your countries, but I was personally affected by this as well. 3 of the closest, bank branches that I used to use sometimes still in the traditional way, closed within the last, let's say 2 years. And we have looked as an example at the numbers of in Poland, and as you can see on the slide, the decrease in the number of bank branches from 2017 until the end of 2021 is quite significant. And similar data can be also seen within other European jurisdictions. So two short comments on the relevance of the research topic, because one might ask oneself the question, like, is this a problem at all? And maybe some of you think maybe this problem will resolve itself, let's say, in a natural way. And I was also, struggling with this thought, but I arrived at the conclusion that if the pace of technological, of the revolution will be kept up, there will always be a generation of digital dinosaurs. At some point, it will be us. But the problem of digital exclusion is not of interim character. The advancement of digital skills in our society will always, lag behind the learning process. So. And the second, the second thing, apart from the fact that this is like a durable problem we need to deal with, is that finding a proper framework of legal care for the elderly should be understood as just a moral obligation, a sign of intergenerational solidarity, and a foundational element of our European values. It's also enshrined into the Sustainable Development Goals of the UN Agenda 2030. So we, shouldn't have any doubts that there is an issue to address. So as regards the remedy, even though we might agree quite intuitively that something should be done here, I think that we might also agree that the legal response is not so straightforward here. So the first question we need to, of course, ask is, who should we regulate? Like, what is the entity who should be who should carry the regulatory burden of this problem? So there are several policy options here. Of course, we could think about making financial institutions, the private sector, somehow responsible for the issue, but we could also think about more publicly guided legal instruments here. And this interlinks with the second question of how we are going to address this question. And here also a variety of different paths is available. So we can, of course, think about educating, that is increasing financial literacy and also digital skills. But if we agree that we should educate, who should educate? Who's taking or bearing the cost of educating the elderly? Again, should we transfer this to the private sector and say it's kind of a, the cost of doing business is also to include the elderly? Or is this some kind of, public function that needs to be performed? Another line of thought is informing. Should we increase informational duties? Will this help the elderly at all? I think there are serious doubts about whether this, policy option is viable at all. And then, of course, the most controversial question would be, can we oblige private institutions from the financial sector to still provide non-digital services? So should there be a mandatory access of people who do not want to digitize to financial services? So, the particular, and I'm coming to my conclusions here, the particular challenge in all of this is that we have not only an interdisciplinary question, which requires us to, use some instruments of the broader social sciences outside of the legal framework to do the empirical work and understand digital exclusion better, but also within the legal field, we have a huge amount of legal fields of inquiry that are overlapping here. So of course we don't only have financial markets regulations, so probably that part most of us are most familiar with. But we definitely also have consumer law and all the literature and everything that comes with it. We also have a very interesting, branch of literature that comes from the Human Rights Division, and in particular, the claims that the access to financial markets is to be understood as a human right. So there's a very interesting discussion in that field. So basically what I'm trying to say that there's lots of policy options to explore, and I think I need to wrap it up here. On the last slide, you see as a summary basically the research framework that is underway. Now the most challenging part for us as a team of lawyers, and we probably need some support there, is the empirical research, but we feel that in order to draft a very specific regulatory response to the problem of digital exclusion from financial services, we still need to better understand both the nature of the exclusion and also the nature of the preferences of the elderly. So this, we feel, must be done in a proper way, and reliance on data that is already scattered out there might not be sufficient. So as I said in the beginning, all questions or comments, even in the aftermath of this panel, would be strongly appreciated. And I hope I was at least, even though I did not, as I said, provide any definite legal conclusions, I hope I at least maybe convinced you of the relevance and the research relevance of this topic. Thank you very much.
Thank you very much, Anne-Marie. Unfortunately, the time is running, so I don't know if there are questions. I guess that the problem you arise is, from a social perspective, really, really very important. We are forgetting all these problems, and I guess that also commenting the previous paper, I guess that we are putting too much emphasis on green sustainability, technological development, but we always forget the word social, the word social, that is of a great importance, because all this process cannot go, could be considered a success if we forget the social problems arising, and I guess that we should balance the public goals of sustainability, technological evolution, with that one of equity and a more equitable society. But thank you very much for your work and for your research. And I guess,
yes. Can I make one comment, and then just a brief one? But if because your topic is basically a very important indeed, Annemarie. And if I may basically suggest to also extend your research also a little bit on a cross-border basis, just to give you a bit of a hint. There's quite some research, particularly in the some research basically done on let's say the higher vulnerability of elderly people for payment fraud. And particularly because of the technological applications, for instance, if you can transfer money with WhatsApp or these kind of solutions. And there is some clear evidence that basically elderly people are more victim to these kind of frauds. And that might be an interesting angle as well for your research, basically, to also look at that particular point, how to create better protection. It's perhaps a little bit of a negative perspective, but still an important one, because apart from the ability to use, being victim of abuse because of the technology, and might also be in a perspective that you might consider. But otherwise, I applaud you with the selection of the topic, and it's highly important. And thank you for your presentation.
Thank you.
Now, Bart, what do you think? I guess we can conclude our first spring talk. I really want to thank you, to thank all the participants, the young scholars that have been so enthusiastically adhered to this initiative. I would like to give the floor probably to Federico Riganti, that strongly supported and was the person who strongly wanted this occasion to debate topics. And probably, Bart, what do you think we can conclude here with a few words from Federico that has this?
No, this is on the roll. So basically, Federico is closing the afternoon.
I don't have the second page of the program. So I didn't print the second page of the program. It was not my idea, but how was organized the things. So on my side, thank you very much to all these the presenters. I learned a lot. I have understood something that I didn't see in the perspective you presented. So thank you very much on my side. Please, Federico.
So I wish to thank you all, of course, Professor Joosen and Professor Brescia. It was a great day, and I'm very happy because, I mean, we had the chance to study together very important topics. Plus, I mean, as I told at the beginning, it's not only a question of law and regulation, it's also a question of friendship, because I mean, I would really like to thank my friends that had the time and spend time together with us today. I perfectly know that this is, let's say, extra job, but they were so nice to take part to this initiative. Today has been the first day, and we're gonna have other 3 days. Well, I would say that taking a look at it was today, the upcoming events will be nice as well. So thank you again to you all for your time, and so fingers crossed for the future. And thanks a lot for what you have said and for all the very interesting topic you addressed in a very precise and very inspiring way. Thank you.